Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Case Studies on Admitting New Partners. Before we begin, we need to cover just a few important items. First, please close any other programs that might be running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order for you to receive those credits, you must complete 2 requirements. The first is that you participate in all 4 of the polling questions throughout today's presentation. And please note that GoToWebinar does monitor your participation in the polls. We will be able to issue partial credit for those who answer 3 out of the 4 polling questions. Next, you'll also need to complete an online evaluation. This will appear on your screen immediately after the webinar ends, so please take a moment to complete that before you close your browser. Once you've met both of those requirements, the certificate will be emailed to you within 10 business days. Now, in order to fully participate in the webinar, please take a moment to familiarize yourself with the GoToWebinar control panel. It should appear on the right side of your screen. There's an orange arrow near the top. You can use that to minimize the control panel. During the presentation, all participants are muted, but you can communicate with us by using the question box toward the bottom of your control panel. Just type your question there and click send. Terry will also be sharing his webcam during today's presentation. You're welcome to resize that, minimize it, or even close that if you wish. Now, on the next slide, you'll see a list of our upcoming CPE webinars. Our President, Joel Sinkin, will be presenting 2 different webinars with CPA leadership this fall. And Terry has another case study session on November 14th, this time case studies on managing partner succession. And you can register for that on the CPE courses section of transitionadvisors.com. Finally, you received a link in the reminder email earlier today that had a PDF of the slides that you could download. I just sent it to you again via the chat box if you'd like to download that and follow along. If you prefer me to send it to you as an attachment, just reply to one of those reminder emails and I will reply back with the PDF attached. Okay, I'd like to go ahead and introduce our presenter now. Terry Putney is the CEO of Transition Advisors. Thank you all for attending and I hope you enjoy the webinar.
Thank you, Nikki. Just quickly, an introduction to our firm for those that aren't familiar with us. We're a national consulting firm. We work strictly with accounting firms. And we are primarily focused on issues related to the ownership of accounting firms. That kind of falls into 2 main categories of mergers and acquisitions, which, as we all know, are very prevalent in the profession nowadays. We facilitate the entire process of a merger and acquisition from introductions all the way through to closing and post-closing transition. And then we also work on owner agreements, and that's the focus of today's presentation is of course the issue of specifically related to how to best admit new partners to your firm. Before we get started on these 2 cases, I'd like to encourage you to. I wish I was sitting across the table from each of you and we could just talk about your specific situation. And I'm happy to follow up with any of you that have questions after the presentation. But I'd also like to encourage you to submit your questions during the presentation. And when it's appropriate, Nikki will interrupt me, and I'll either answer the question at that point or make sure I do before we're finished, if time allows. After we go through some basic concepts in the next slide, a few slides on owner agreements, internal valuations, and admission of new partners, I'll go over 2 recent cases that we've been involved with that I thought had some interesting components to them that sort of apply in many cases to situations that we run into. RJB LLC is a $5 million 4-partner firm. We're still working with both of these firms, by the way. So these are live situations. I don't know whether anybody from either of the firms is on the presentation, but if so, I've protected the confidentiality of all the information, and I've slightly modified it so that no one can identify who we're talking about. But is a 4-partner firm that has right now an unaffordable partner agreement based on how it's set up. And in the process of addressing how to admit new partners, which is going to become necessary because of partner succession, we also restructured that partner agreement. So the two went hand in hand. The second case is Ellen Associates, a sole proprietor who is looking at succession within the next 5 years and has identified within his management team 3 people that he believes are capable of taking over the firm. So the process of actually admitting these 3 people is also coinciding with the buying out of the sole proprietor. So I thought there was some interesting tax issues that we ran into in this particular case, and how we addressed them were a little bit unique, and I thought would make for an interesting case. Just to give you an example of how we approach these engagements, and it's a pretty standard process that we use. The first thing we do is obtain, of course, all kinds of financial and operating data on the firm and all the key constituents, including at least the owners, but in the case of where the point of the engagement is also admitting new owners, we'll also gather information on those specific candidates. We interview the management team to gain an overall understanding of their personal perspective on the issues. And it also gives us the opportunity to start floating some alternative approaches that we might present as recommendations for how to address their issues. It really is the very beginning of the negotiating process, because in every case with an accounting firm, there needs to be a consensus that's reached by all the parties in order to make sure that you've got an agreement that is going to work. And then finally, we circle back with the management team with our high-level recommendations after we've obtained all these perspectives from the entire management team. And the final outcome is a report to the owners on the detailed recommendations. In each of these 2 cases that we're going to talk about today, those reports have been presented. We're in the process of negotiating the final terms within the partner group, and will assist either in drafting the new agreements or will work with their attorneys to do that, and oftentimes both of those occur. This is an opportunity for us to start with our first polling question. Nikki, I'll turn it back to you. We're not hearing you, Nikki. Excuse me. Gretchen, I'm not hearing you. Yeah, I don't know what's going on. I can't hear them. Okay, I'll go on. Nikki, let me know if you're not hearing me, because I wasn't hearing you, and Gretchen's going to check with you and see what's going on. In assessing, obviously, whether or not the firm, in looking at admission of new partners, the first issue that every firm has to deal with is, are they ready to admit new partners? And one of the issues that we run into, of course, with very large firms, say 300-400 partner firms, it's a constant process of admitting new partners. It's done every year. There's a flow of new talent in. There's a flow of retiring partners out. It's really a matter of kind of, if you can imagine a water spigot, how fast do you turn the spigot on, or how much do you shut it down? But it's not something that is considered a big issue as to firm readiness. The firm is always ready to admit new partners. Most of the firms we work with are going to have 10 or fewer partners. Admitting a new partner is a big deal. Oftentimes has a significant impact on the profit pool, the potential dilution of the profit pool, and the capacity for a new owner becomes a major issue. So one of the things that we look at, and I will tell you that firms that don't grow have difficulty managing this process. If you're not growing, then admitting a new partner means splitting the same pie up into more pieces, which is not very motivating for the existing partners. So in looking at the firm's readiness, one of the things that I recommend is that you look at what your succession needs are going to be and the timing of those. And then the second step is to look at the particular individuals that are leaving and whether or not you need to replace that person or not. We call a partner that needs to be replaced with another partner, a new body, role succession, and a partner that's leaving that doesn't need to be replaced by a new partner or a new body, where those duties can be reallocated amongst the existing partners, role reallocation. So in looking at your role succession partners, look ahead and say, how many years do we have? And our recommendation is that you at least give yourself 4 years in advance of that succession, the date at which that partner is either going to leave altogether or substantially cut back in time. Give yourself a lead time of about 4 years. That's 2 years to make sure that the person that's replacing or people that are replacing that partner are in a state of readiness to actually take on the duties, and then 2 years of active transition of those responsibilities, which oftentimes are significantly made up of client relationships. And so give yourself sort of a graph or a matrix. Look at your partner group. If you've got partners that are, say, a partner that's going to be about 7 years out, you know that you need to have somebody in place within the next 3 years in order to properly manage that activity. The second issue, of course, is whether or not the people that are on your bench actually are capable of becoming a partner in your firm. One of the things that I've found is that oftentimes we're sitting around a table of 6, 7, 8 partners in a retreat, and we're talking about the bench, and there's no clear consensus amongst the partners as to who's ready and who isn't ready and why they're ready and why they're not ready. It's mostly a kind of a seat of the pants sort of gut feeling. It makes it very difficult to actually have the conversation, let alone manage the situation. So one of the recommendations that we use is to actually build for your firm a list of the characteristics of a partner. What specific skill sets do people have to be successful as a partner in your firm? Here's an example. This is actually taken as a composite of many of the firms that we've worked with. There's some pretty obvious things in here: personal productivity, the ability to generate billable time at a high level, at a high billing rate, creating a client following within the firm, client management, of course. Practice development is always an issue, but there's a lot of other components that aren't so objective in their measurement. And what I recommend is that you go through and build this list for your firm. Use it as a benchmark to evaluate your people. Where you have gaps, and you always will have gaps with almost everybody, they're missing something. Create a development plan that will basically requires 3 different levels or 3 different types of training. The first is formal training, external training. For instance, and I'll give you an example here in a minute of some organizations that help with some outside formal training for development of partners. The second is mentoring, which is somebody in the firm, a partner in the firm, actually helping that person on a one-on-one basis, on a regular basis, assess what they're doing well and what they're not doing so well and how to fix those things. And the third is the use of on-the-job training, giving the person more and more stretch goal or stretch opportunities, stretch tasks to develop their skill set. One of the techniques of doing that's becoming more and more popular within firms is the use of non-equity partners. There's basically 3 different reasons to have a non-equity partner's role in your firm. One is to help partners transition out from equity partner through a non-equity partner role to complete retirement. The second is, and that's often used, by the way, in mergers and acquisitions, if we bring somebody in who's going to be working with us, 3, 4, 5 years, but we don't want to have them be an equity partner, we'll put them in a non-equity partner status while they're in that transition role. Transitioning in, and of course then if you have people that for retention purposes, you feel like you can't make them an equity partner, but you want them to be with you long term and have many of the roles of a partner, you might put them in that position on a permanent basis. My concern is when you see firms that have too many permanent non-equity partners, basically it tells me that they're kicking the can down the road, that they're setting themselves up for a problem later when they don't really have the bench that they're pretending that they have. A very appropriate use, though, is for transition from a non-partner role into an equity partner role. Oftentimes, this might take 1 to 3 years. It gives the firm an opportunity to train that person finally in the role of a partner, because most of the time they're given all the responsibilities of an equity partner other than ownership. And it also gives that person a proving ground to prove that they in fact can handle the responsibilities at a partner level. So I think it's an excellent use of that. It's a very as you can see from the statistics here, more and more firms are using it. I've seen firms where we have as many non-equity partners as we do equity partners in the firm. I think that's maybe a little bit of an overuse, but it certainly is a popular tool nowadays. These are 4 excellent training. I have a relationship with these only on a peer basis. We don't have any kind of financial interest in any of these organizations. These are the 4 that I recommend you consider for training partners, making sure that they're developing. They're used not only for candidates that are not at partner status yet, but also for newly minted partners for final development. So those are all 4 that I would consider, or I would recommend you consider. This just happened last week. We had an article published in the Accounting Today on August 13th. You can download it from our website under the Articles tab. The flawed economics of admitting new partners. And the reason I'm pointing it out, because there's other articles that we're going to point out later that are also examples of some of the information we're talking about today. This particular one addressed head-on the issue of sweat equity in owner agreements. And what I believe is one of the biggest problems with admitting new partners, where the firms that we work with are typically struggling with this issue. That's why they came to us. Oftentimes, they're using the equity method of accounting, and the concept of sweat equity gets left out of the equity method. And so that article, I thought we did a pretty good job of addressing some of the downsides of the equity method. I'm going to go into that in more detail here right now. So a common situation that we would run into would be a firm that was, say, founded by 2 co-equal founders, meaning they're not necessarily equal, but mostly equal, who own most of the equity when we get to the firm. So oftentimes, this might be a firm where the 2 founders maybe left another firm with books of business, or sometimes they started the firm from scratch. They either started off with equal ownership, or maybe they started off with ownership that reflected the books of business that they brought to the firm. So let's just use an example. Say one of them has 60% and one of them had 40%. And then as time goes on and the firm grew and they recognized the need to grow the partner group, they started admitting more partners. And the problem is now this firm that started off maybe as $1 million firm, all of a sudden is a $2 or $3 million firm. And for the firm to have, for the new minority partners to have any substantial stake at all was going to cost a lot of money. And I'll give you an example of how that works in a minute. And so they basically said, look, the amount of ownership isn't really important. We don't really use it for compensation that much. And we don't, it's only going to be when somebody retires. That's not going to happen for 15 or 20 years. And so maybe they bring these 2 new minority owners in at a 5 or 10% stake. Well, over time, those people grow, of course. And when they were offered that 5 or 10% stake for whatever they paid for it, in some cases, it might have been a minimal amount of money. they didn't care. They just wanted to be a partner. When all of a sudden we're 10 or 15 years down the road, the two founding partners are nearing retirement. They own, at this point, say 40 or 45% each. The firm's much larger. That 40 or 45% is a very large number. And the 45, say it's 40, 40, 10, 10, doesn't reflect at all the contribution that those four partners are making to the firm at that time. So needless to say, there's a problem with not only how am I going to, acquire the rest of the ownership of a firm that I helped build, and why should I be paying for the buyout of two founders that I recognize were the founding partners, but quite frankly, where we sit today has a lot. I'm responsible for a lot of that success. The equity method is basically I own X percent, which is oftentimes arbitrary. I mean, I'm not saying it may be stock ownership, so I don't mean that it's not real, but how much I own might have been determined on an arbitrary basis at some point in the past, times a formula value for the firm. So for instance, I might own 40% of the firm, and we decide that the firm overall is worth 100% of revenues plus book value. And therefore, my ownership is 40% times 100%, $2 million firm, that's $800,000 as an example. The two most common alternative methods of that, of valuing a firm and allocating that value, are the compensation-based system and the unit-based system. The compensation-based system says that my value is going to be determined by a multiple of whatever I'm making, usually oftentimes on an average basis over a 3 or 5 year period. So if I'm making, say, $400,000 a year, and we decide that my value in the firm is worth 3 times compensation, then my value might be $1.2 million plus some allocation of book value. In the unit-based system, it's similar to the equity system, except that because we're using units and because those units change every year typically, we can allocate those units and certainly the incremental change in those units on some basis on an annual basis, which allows us to recognize the contribution that individuals are making to the firm. And it also allows us to bring in new partners at a much lower value because we don't have to allocate any intangible value to them up front. We allow them to earn that intangible value over time, which of course is sweat equity. One of the things to keep in mind on the compensation method, I'll go back, is that the basis for the compensation method, which typically in the past was always 3 times compensation. And if you think about the standard profitability of most accounting firms, which is a third, meaning a third of the revenues ends up being partner compensation. 3 times 1/3 is of course 1. So the compensation method was considered a proxy for 1 times revenues, which has kind of always been historically a benchmark for valuations. And it was really a matter of saying, we're going to allocate that value on something other than an arbitrary ownership percentage. We're going to allocate it based on compensation, but we're going to end up at the same value. So some of the trends that we're seeing right now as a result of the Rosenberg survey is the 44% of the firms that responded in 2017 used the multiple of compensation method, and the equity method is declining in its use. The AAV or unit method, which I just described, is increasing in its use. There's still firms using book of business, which means that each partner has a distinct book of business, and we're going to pay them based on that as opposed to some ownership percentage. So oftentimes we're using the same revenue multiple of say 1x on the book of business, but that's going to be, the allocation is going to be based on how much business we're managing. I will tell you that this survey, these results are across the spectrum of all the firms that responded to the survey within based on size, that larger firms by far, by a wide margin, will more often use the compensation multiple method. Firms that have 5 or fewer partners are much more likely to use the equity method. When we look at internal valuations, which is a part of this as well, of course, the concept of what makes a valuation affordable really comes into play when you're buying somebody out. So the concept of what's affordable and what isn't affordable should be defined by whether or not the buyout is going to be self-funding. So we decided self-funding by using this formula. When a partner leaves, let's say a partner's leaving making $350,000, including all benefits, the first thing we have to do is replace that person, which can vary obviously from partner to partner. One of the minimum in assessing replacement cost, at a minimum, you have to replace their productive capacity. If they're generating, say, 1,200 billable hours at $300 an hour, that's $360,000. Somewhere between 40 and 50% of that is probably the cost to replace that production. So the first thing we do is lop off that 180 to 1,000 or so dollars as replacement cost. And that gives us how much capital we have left to do two things, which one is to fund the buyout, and the second is to leave behind a reasonable residual for the rest of the partners so they don't feel like they're running in place for the next 10 years, if assuming a 10-year payout. If you don't meet this requirement, the only alternative is for the remaining partners to either borrow money or take less compensation in order to fund the buyouts. And so the first thing that we always go through is this analysis to find out if the terms and if the amount of if the valuation is properly structured. Looking again at valuation guidelines, again using the Rosenberg survey and also the AICPA 2016 PCPS survey, you can see that, and this is surprising for a lot of people, because a lot of people have an understanding of what firms are worth based on what they think they're selling for on the street, which oftentimes is based on solicitations you might have gotten from a broker, for instance, who will tell you, I can get you X percent of your revenues. These are real numbers. They're based on these surveys, and hundreds of firms responded. Firms that are in excess of 20 million, basically the goodwill portion, whether it's defined by compensation or a multiple of revenues, is averaging about 77%. Even the firms that are under 2 million are under 90%. Within the PCPS survey, which tended to skew more towards smaller firms than the Rosenberg survey, you can see that only less than 40% of the firms are actually using 1 times revenue still, and only 4% are using more than 1 times revenue. So one of the things that's surprising to a lot of practitioners is, why isn't my firm worth 1 times or even more on an internal basis? And one of the things to consider here is that in an external valuation, oftentimes the terms are contingent. The deal is contingent, which means that there's a lot of risk of retention potentially if the deal isn't if the transition isn't properly managed. The second is that, in essence, your owner agreement, in the case of internal deals, oftentimes they're not contingent. They're oftentimes fixed at the date of retirement. The second is that your owner agreement is, in effect, a put option, which means that when a partner leaves, they have a contractual obligation from the other partners in the firm to buy them out. If you're going to sell on the street, you're obviously open to whatever the market's willing to bear, whatever buyer you can find, and whatever the market conditions are at the time. There's a legacy factor here. Oftentimes, it's important to the retiring partners that they leave behind a firm that is capable of sustaining itself. That's important to them. Plus, it also creates an opportunity for a better transition, and one that they're more in control of than selling their firm externally. So for those reasons, I think it's a discount from what might be perceived as market value, especially in smaller firms, is justified. Another statistic here before we get into the specifics of these two cases. According to the Rosenberg survey, this is what the initial buy-in is averaging for firms that are of these different sizes. The buy-in can be in the form of capital contributions. I think it's unusual for someone to actually pay all of this at once. I run into very few situations where that's the case. Oftentimes it's financed over is even 5 or 10 years with a compensation adjustments. And so, but it gives you some idea of the kind of skin in the game that firms oftentimes are expecting from their new partners. Finally, before we get into the cases, there are a couple of past webinars that you can download from our archives on our website that deal with the issues that I just went through with respect to owner agreements and also admitting new partners if you want more information. And this is how you, what they're called and how you can get to them on our website. With that, Nikki, I'm going to turn it back to a polling question for you.
Okay, can you hear me this time, Jerry?
Yes, I can. Thank you.
Okay, great. I've launched the next poll. It's on your screen here. This one is, does your firm have an owner agreement? You'll see the options there. Yes, everyone signed it. Yes, you have one, but not everyone has signed it. No, you need one. No, and you're not sure that you need one. I apologize for the audio issues. It didn't affect the poll, though. It looks like nearly everybody got to vote last time. So if you didn't have a chance to answer that first polling question, you can send it to me through the chat box, and I'll make sure that it gets recorded for CPE purposes. Okay, it looks like nearly everyone. I'll leave it open just for a few more seconds. If you haven't voted, please do so now. Okay, I've closed that second poll. The results are on the screen there. So we've got kind of a bit of a mix. 43% say yes, and everyone has signed it. And then an even split between no, we need one, and no, we're not sure that we need one.
Okay. Obviously, if you're going to admit a new partner, you need one. So if that's what you're thinking about doing, and that's probably why you're on this webinar, you've got to start at ground zero, at square one here. Okay, so let's get into one of the cases. First one is the larger of the two firms. It's a $5 million firm, as I mentioned before, with a 33% profit margin, which is normal. 4 partners, operating as an LLC, taxed as a partnership. Every once in a while, I'll run into an LLC that's taxed as an S corp, which I think is a huge mistake. You know, S corporations and C corps, for that matter, which may become more prevalent with the new tax law, have some advantages in terms of how compensation's taxed. But when it comes to transferring ownership in the firm, especially internally, they are a huge impediment. So I would recommend that if that's your concern, is how to transfer ownership, either buying out partners or admitting new partners or selling your firm, that you have much more flexibility when you're operating as a partnership, much more flexibility in terms of tax treatment. The firm has a normal amount of receivables and WIP for a firm this size of about $700,000. Actually, it's a little low. Oftentimes, that'll run about 25%. And there's one partner, the senior partner, who's already in transition, and in fact is already a majority of what he owned was already being purchased when we came into this situation. The firm was founded by a partner who started his transition about 3 years ago. Over the past 7 years, they admitted 2 new partners. There was already one other, or actually were 2 other partners that ended up leaving before we got there. And so at one point they had 4, then they got down to admitted a new partner, and then there were 3, and now there's 4 again. There's been 2 new partners admitted in the last 7 years. The new partners, they use the equity method of accounting, or not equity method of accounting, equity method of managing their owner value. So the 2 new partners were required to pay full value for a 15% stake in the firm, which at the time was an $800,000 obligation. And they were required to go to the bank and borrow the money. So they were willing to do it. They did it. They still owe a lot of it. And but one of the problems that the equity method created was this other partner, who is now the majority partner, started off as a minority partner, and after being with the firm for about 15 years, had accumulated the largest book of business by far. He's managing a $3.5 million book of business, and said, you know what, this isn't working for me to own this small minority stake that I started with. So as a part of going through this whole buyout of the founder and admitting new partners, he negotiated a different equity stake and ended up with about 60% of the ownership, which is where we stand today. So the founding partner still owns a 10% interest. This was, for some reason, felt like he wanted to have an ownership as he went through his transition. We'll start the final buyout of his 10% here in the next year. He still owed $2.2 million for out of a $2.5 million that was recognized as his buyout 3 years ago. The firm, obviously values itself at 1x, and the current ownership split is 60-15-15, which will, of course, automatically adjust to through accretion to about 67 and 16 and 16, something like that, when the final 10% is acquired. The problem is that the firm knew that this approach was unsustainable, that it was proven to be unsustainable when the minority partner became the majority partner and had to do that through a negotiation. Just based on his ability to make his case, and which was obvious, he was able to acquire more equity. It was going to be difficult to attract new talent to the firm in the form of new partners because of the cost that was necessary. For instance, just to show you how out of whack this is, one of the 15% partners is now the managing partner in the firm. So it doesn't, really the ownership percentages don't really reflect what's truly going on with respect to everybody's role. And so they came to us and said, how can we fix this? For me, this is a classic example of the downside of the equity method. The problem is that the equity method has no built-in recognition of sweat equity. So when you think about it, the founding partners of the firm, let's say we started a firm with very small books of business. And over the years, we grew it through our sweat equity. We admitted new partners. We may have actually bought out some partners. And in the end, we end up with whatever we have in the way of ownership, which is a significant stake in the firm. But we never wrote a check for any of that. And now we're asking new partners to come in who at the point don't have any sweat equity in the firm. But over time, we know we'll actually create sweat equity. But in order for them to acquire that stake, they're going to have to do it by writing checks. And so it creates this problem of attracting and retaining talent. And in today's world, where talent is so scarce at the partner level, they have options, whether it's within the profession or not. But we're seeing more and more cases of partners being offered opportunities to buy into firms and turning them down. And I'm going to talk about that in the next case, by the way. So we end up with this choice in the equity method of either offering a very small stake, say 5 or 10% to start with, because it's affordable, or acquiring equity at a very high value, a very high cost, which is what happened in this case, which is unaffordable. So we decided that the best approach to this would be to convert this firm's owner agreement to an AAV or unit system. In the AAV system, intangible value, which in the case of equity would be 1 times revenues, is expressed in terms of units. And usually there's $1 of revenue equals 1 unit. As the volume changes annually, the units change, and typically the volume goes up, so there's more units created. And that change is allocated to the then current partners. That is the first recognition of sweat equity. So even though I may not start off with any units when I become a new partner, as the firm grows, I share in that growth and I get allocated some of that value through the annual allocation of new units. And then as retired partners are paid off, their units are acquired and reallocated back to the then current partners. And we do it as we pay for them. So for instance, if I retire with 1 million units and say I'm owed $1 million as a result, and that's paid to me at the rate of $100,000 per year, the $100,000 that's paid that year is what's allocated back to the then current partners. The way you allocate it can be totally up to you, and it can change from year to year. Some firms do it equally. I don't usually recommend that, but that's an easy way to do it. Some firms do it based on relative compensation. Some firms go through a performance evaluation process just like they do for compensation and reward partners for certain performance attributes. Some firms do allocate some of it based on new business that's brought in. So it's up to you how you allocate the incremental units, but the point is that you're recognizing sweat equity when you do it, and you're creating a dynamic ownership system that isn't stuck on some arbitrary starting point that can only be changed by writing a check. New partners are typically not required to buy units up front. They are required to make a capital contribution, which is normally based on the accrual basis equity of the firm at that time. And I'll show you how that works here in a minute. They participate in the firm's growth. They participate in buying out new retired partners, and therefore they acquire some value over time, and a significant amount of value due to buying out retiring partners. So in this case, we had $5 million, obviously. That created 5 million units. Again, this is the example of where we started. The tangible equity was $700,000, and so the new partner was required, who was going to be asked to make become a 10% owner, would only have to pay in $70,000 in this case. But then again, they were not allocated any of the intangible value up front. So the $70,000 only represented their 10% stake in the tangible capital. And then over time, they would be allowed to acquire more ownership percentage, which, you know, the ownership percentage in this case is only going to be used for voting purposes. In most firms that I've worked with, never vote their shares anyway, but would only be used for voting purposes and also for purposes of allocating tangible capital. So the point was that oftentimes firms, when they get into this kind of a system, end up with equal ownership amongst the partners, and new partners would be required to make an additional contribution down the road, but it wouldn't be at a significant cost. So the $5 million in volume represented 5 million units. We allocated the first 2.5 million of those units to the liability that we had to the retiring partner because that liability hadn't been paid for. That left 22.5 million units, which we allocated based on the current ownership allocation of equity of the 3 partners that were in the firm, going to be remaining in the firm. So we started with the same equity allocations that we had in the equity method, and the goal was that going forward, we would be making changes in how we allocate additional value that's created. So 2 years later, we don't know this yet because 2 years hasn't happened, but let's just assume that the volume increased, you know, only 500,000 units, that we paid off another 500,000 of the debt owed to the retired partner. And if we allocated those million new units that were created through those 2 activities equally, including this new partner, then this is what we'd end up with. So you can see that the new partner has basically been allocated 250,000 sweat equity units. Each of the other 3 partners have also been allocated sweat equity units, and you can see how the ownership over time of the intangible equity is going to change. Now, again, this is assuming an equal allocation. That's just for illustrative purposes. I wouldn't necessarily recommend you do it that way. Okay, that leads us to another polling question. Nikki?
Okay, our third polling question is on the screen now. This one is about your approach to valuing the owner's interest in the firm. So do you feel like it's fair and affordable? It's fair, but you're not sure that you can afford the buyouts? Or do you think it's too high or too low? And of course, those of you without an agreement can choose the last option. This is number 3 out of 4 polling questions. And just a reminder that you do have to do all 4 in order to get the 1.2 credits. As long as you've done 3 out of 4, you can get 1 CPE credit. Okay, that's nearly everybody, so I'm going to go ahead and close it. About 50% are in that category because they don't have an agreement, and then the ones who do are split exactly evenly between fair and affordable and fair but not sure we can afford it.
One of my comments on that, on the fair but not sure we can afford it. If you go through the analysis that I gave you earlier, I don't find a lot of firms that have terms that are unaffordable. That'll happen. I mean, where you see it is if the payout is, if you're trying to do the payout over say 5 years, certainly if you have a valuation that's in excess of 1x, or if you're trying to use a non-deductible form of payment, for instance, if you're trying to buy stock, if you're in a corporate form of ownership, those are things that'll create an unaffordable buyout. Oftentimes, though, when that's not the case, when in fact, once you go through the formula that I gave you, you do have a reasonable set of terms. What makes it unaffordable oftentimes is we're not sure that we can replace this person. We don't have a strong enough bench. We're not sure we have a good transition plan. We're not sure we're going to keep this person's clients. And so the issue, the unaffordability, isn't about the terms, it's about the whole transition plan and the succession plan. So make sure that you know what you're talking about here when you say unaffordable. And that's, in the engagements we get involved in, we obviously we address both of those equally. We're trying to make sure the financial terms make sense, and we're also trying to make sure that the business plan that backs up the succession and transition of partners makes sense. Okay, so now we're into our second case. It's a smaller firm, $2 million, sole proprietor. He's 65 years old. Operates as an S corporation, and I use this example because I wanted to demonstrate some of the problems we have with corporate forms of ownership. He's billing 800 billable hours a year, $300 an hour, and he's got the receivables and WIP that are on here. And he identified a couple years ago 3 of his managers that he believes are capable of taking over the firm. He has a 5-year transition plan in mind. And in order to minimize the cost of the tax cost, his initial offer to the 3 managers was to buy stock in the corporation. So he's got this $2 million corp with a $325,000 book value. He actually offered to sell them the whole thing for $2 million if they do it in stock. Well, they ran the numbers and decided we can't do it. We can't afford it. It's not. We can't deduct the payments because it's stock and the cash flow is not going to work. So he came to me and said, "Look, how can you help me with this issue of bringing in these new people because I've got to get them in place so they can buy me out." So the first thing we looked at was the potential use of personal goodwill. Because he was a sole proprietor, of course, he didn't have any kind of employment agreement with his corporation, meaning that he wasn't restricted from taking clients from the company. So he, in fact, could create personal goodwill. But I don't want to get too technical here, but under the anti-churning rules of Section 197F9, which is 197 is the code section that deals with the amortization of intangibles, the corporation wouldn't be able to amortize the goodwill because he didn't meet the requirements. So now we're stuck with, what do? We either have a non-deductible deal, which would have to be at a much lower price to make it affordable, or we're going to have to use deferred compensation, which is the only option that a corporation has. It's either buy stock or pay it out in deferred comp. And of course, deferred comp, which is a very common way of doing it, has a lot of tax associated with it, not only for the income tax, but also the payroll taxes. So we came up with a somewhat unique approach here. What we decided to do was we formed a new entity. And that entity would be wholly owned by the succession team. So we created a new company. He has no ownership in the new company. And the new company would buy the assets of his company, his firm, and create an amortizable asset. So now we got capital gain treatment on the goodwill portion. And we created a control feature within the purchase agreement so that in the case of any kind of default, or in fact, there was he has a role in the new entity, but not an ownership role, so that he can still make sure that the transition occurs properly to his new management team. We again, we kept the value at 1x on both the intangible value and tangible value, and the new buyout, and the terms met the affordability test that I went through before. We used the new entity. Working capital was provided both as a combination of new owner capital, which created the skin in the game. We go back to those examples that I gave you before of how much investment is required of new owners. We didn't expect 150,000 each, but we did expect them to make an investment that they personally were able to raise either through their own means or by borrowing money. And the seller, in this case, the sole proprietor, also provided some of the working capital from his own assets. We had a 10-year buyout, which had no interest involved, even though the interest had to be imputed. And I would tell you that this is an issue that oftentimes is overlooked in buyout terms, is the issue of interest. If you add 6% interest to a 10-year buyout, you've increased the cost of the buyout by over 20%. So if you're comparing your agreement at 1x with a firm who's, in most firms, do not put interest, require interest on deferred payments, if you require interest and you're comparing yourself to a firm that doesn't, you're actually using a 1.2 multiple. So keep in mind that the interest rate and the interest actually is a factor in the valuation. We also capped all of his compensation and ongoing purchase payments at 15% of revenues to make sure that the deal was affordable for the new owners, and any deferral due to the not meeting that criteria would be carried over into a future year. And he was given a 5-year employment agreement with a decreasing amount of billable hours as his compensation. So he would be paid 40% of what he produced in billable hours each year. That was his ongoing compensation. All the transition work that he was doing would be basically uncompensated, although in my mind, the purchase payments for me were the compensation for his transition. So the affordability test that we went through, he was making $440,000 prior to the sale. The replacement cost for his time that he was producing about $240,000 a year in production. We set the replacement cost at $100,000, and the purchase payments, the $2 million over 10 years would be $200,000 a year, would leave $140,000 of residual. So that gives you an example of how this affordability test works. So again, looking at the admission of new partners in this particular case, the trick in this one was, rather than trying to bring them into an entity in a classic sense that would create a poor exit strategy for the seller and or a poor exit strategy for the new buyers, we created a new entity which basically allowed us to gain the best tax treatment for both parties. I think this is our fourth polling question. Is that right, Nikki?
It is. This is our fourth and final question. How many partners in your firm will likely slow down over the next 5 years? Is it none, all, most, or some? Keep it open about 5 more seconds. If you haven't voted yet, please do so now. Okay, I've closed the poll. We've got 53% say some, and then 19% none, 17% all, 10% most.
17% all. So my guess is that you're a sole proprietor or you got your hands full if you have more than one partner. If you're a sole proprietor, obviously, hopefully you've got somebody in mind to bring into the firm to be your successor, or maybe a couple people, such as the last example. All right, so some suggested additional info. These are webinars, additional webinars that are available on our website that you can archive. These are all, you don't get CPE if you review these, but you will obviously get the information that was available. And I think you'll find many of them interesting. Additional reading, we've written, I think at this point, 28 articles for the Journal of Accountancy over the years, between myself and my partner, Joel Sinkin. Some of the ones that I thought were relevant to the topic today are these four. The most recent, this building a state-of-the-art M&A target, is actually about the impact that technology is having now on the merger and acquisition of accounting firms, both from the standpoint of the acquiring firm and the firm that's being acquired. So that one just came out in August. This issue, in fact, the most current issue. Also, for additional information, I'm a member of the CPA Consultants Alliance, and this is, all four of the recommended organizations that I had listed earlier, except for one. The Growth Partnership is not represented in this list, but the other three are. This is a consortium of consultants to the accounting profession, and our goal with this group is to provide information to the accounting profession in terms of white papers and other types of information. We wrote a book that you can acquire from CPA Trendlines. It's actually $100 cost of the book. I think there's actually a discount from that if you go to CPA Trendlines. I think the actual full value is about $100. And you can also download from our website white papers. And in fact, we're in the process of drafting another one as we speak that should be out before the end of the year on converting from a compliance-oriented culture to one that is consultative, which is a current issue within the profession. So I recommend you go to cpaconsultantsalliance.com. And for more information about us and to submit any questions you might have to me, this is the contact information. With that, I'll turn it back to Nikki.
Okay, thanks, Terry. We did just get a question just now. Would partnering with another existing firm be a reasonable exit strategy?
Basically, yes, if they're in a position to replace you. So for instance, if you're talking about a traditional kind of practice continuation type agreement, and oftentimes you see two sole proprietors that enter into practice continuation agreements, or two firms with small firms, say 2 or 3 partners each, that enter into that type of agreement because they feel comfortable that that type of practitioner would relate well to their clients. That doesn't create any kind of realistic succession for you because that firm's capacity doesn't have the capacity to replace you. If you're talking about, for instance, say you're a 15-person firm and you're merging into a firm that has at least 50, if not more, people. And my rule of thumb is that you want to look for a firm that is at least 3 to 4 times your size to get a realistic approach to replacing you. Then that's a realistic way to deal with succession, without a doubt. The other approach, of course, is to find, and these are hard to find, but is to find a small, young sole proprietor, say one that's got a $400,000 or $500,000 practice that's maybe is fairly new and has the capacity, because their existing practice is small enough, that they can actually replace you. We do see some of that working, but it's very difficult to find those people. The more common approach, of course, is the upstream merger into a much larger firm. Anything else?
Okay. No, that's all. Thanks, Terry.
Okay.
It is the end of the webinar. I'll go ahead and close it for everyone. Just a reminder, before you close your browser, please do complete that survey. If for some reason you have any issues with that or it doesn't pop up for you, you can just reply to the email that you'll get in about an hour, and that'll come to me, and I can send you the link to do it later. The articles that Terry mentioned that he recommended are all included. Links to those are all included in the follow-up email that you'll receive in about an hour. And as Terry mentioned, you can find all of those archived webinars on our site. So thanks again, everyone, for attending, and we hope you'll join us for a future webinar.